So convertible debt. Why would you want to do convertible debt instead of a preferred round? Well, it's quicker. It's quicker, which also means you pay attorneys like me a little bit less money, and sometimes a lot less money to help negotiate them for you. There's fewer terms. There are fewer documents. They're just really efficient. They're also easier for a less sophisticated investor to get comfortable with. The main reason for that is because you're not setting a valuation. Many of you may know this, but convertible debt is in the form of debt. Someone makes you a loan. That money that's loaned to you will eventually convert into equity at some price that's based on the terms of the note. But that price, since it's floating, doesn't mean it's a valuation today, which means that if someone is uncomfortable setting a valuation, you can easily come to a conclusion about how to use a convertible note. It's got built-in downside protection because it's a note. It means if the company were to fall apart, which no one wants to happen, but if it did, the person would be entitled to their money back before the common shareholders. And then it's got some upside in it, and that's because the note is convertible into equity at some price. The only terms you need to worry about with a convertible note are how much you're going to take, the interest rate, and usually that's a secondary consideration. People are not typically investing in you for the interest rate you're going to pay. If they were, they'd be a bank. And you're typically in a startup or emerging growth phase, not bank lendable. So you're not really doing this for the interest rate. You talk about a maturity. We'll talk a little bit more about that in a moment. Whether or not it's secured, in my experience, it's pretty rare, as in very rare. I haven't seen this in a few years now for anyone to even ask for a secured convertible note. And then they convert in a financing or in a sale at some price to be determined in the future. Typically, that's in a qualified round, and we define in the note what qualified means. Usually, it means a round of a certain size. Usually, it converts at a discount. And what that's for is if you're selling your shares in that round at $1, typically the discount will be like 20%. So the note holders would convert their shares at 80 cents on the dollar. So they're getting a 20% discount on the shares that everyone else is paying $1 for. And the reason for that is because their money went in early. There is additional risk from going in early, and you may have used their money to create some of the value that was used to pump up that price to $1 a share. And then also there are terms on liquidation or sale, and there are multiple flavors on what could happen there. And talk to your lawyer. I'd suggest you get a good one about what that could be. You can convert the note into a new series of stock, which is a little bit more complicated. You can convert into a previously issued type of stock like common. Or you can set a price now, which wouldn't be typically what's done. You could set a discounted price to what happens in an acquisition, or you can just say the note gets repaid at some multiple. All those are alternatives. And that's, the good news is that's all you're talking about in a convertible debt financing. And so it's not really that hard. So what's a SAFE? SAFE is a little bit like a note, but it's not. And there are different flavors of a SAFE. There used to be something called a KISS. I haven't seen that used in a long time. It's a keep it simple security. But a SAFE kind of won the battle of these sorts of instruments. A SAFE was actually invented by Y Combinator in the forms on their website. So in theory, it's real easy to use. You just, you can print it off the website and use it and sign it. And I would not recommend that though, and I'll tell you why in a moment. It's based on the concept of a note, meaning like a note, the money goes in as kind of a placeholder for equity, meaning it's money that's lent to you kind of, but there's no maturity date, which is great. And in the old days, when you got a convertible note, and currently I have clients raising money on notes and SAFE sometimes concurrently, the note has a maturity date, and that means it's due and payable, say in a year, maybe a little longer, sometimes a little less, but money's due and payable. What happens if the money becomes due and payable and you don't have the money, which is typical of startups, emerging growth companies? You're taking that money and you're burning it to move down the path, and you don't have the cash to pay it back when the time comes. That fact is what led to the invention of a SAFE. Like, why would you have a maturity date when these folks really want to invest in equity? They're not really interested in getting their cash back anyway. It's not really a loan. So let's eliminate the whole maturity date concept. And that's what happens. SAFEs were invented. There's typically no interest rate. I've seen an interest rate in one SAFE. I've only seen it once, and it was a pretty aggressive investor. So not typically an interest rate, not typically a maturity date. And again, it acts as a placeholder for a future equity investment. So why is it good? Same as a note, typically no valuation discussion. And we can talk about that in a second. There's kind of an exception to that. And it's better with no interest to maturity. It can be simple and it can have even less negotiation. But one kind of word to the wise is they can end up being standalone instruments, which means if you have 5 or 10 people you want to talk to about getting in a kind of an early stage investment in your company, and you issue a safe to each one of them could theoretically demand different terms, and each one of them stands on their own. So that means if you need to modify the terms of those safes, you're having a conversation with up to 10 people to modify it. And sometimes the safes need to be modified for one reason or another, future financing, how they convert, et cetera, et cetera. So just as a heads up, word to the wise there. The other thing to keep in mind is, like I said, the version that's on the Y Combinator website is one that's drafted by Y Combinator, who is an investor, and they typically work with investors. And there's nothing wrong with the safe that they created, but it is less favorable than it used to be for the founders and for the emerging growth companies. Their old safe used to be what's called a pre-money safe, and that meant the money that went in the safe was actually converted as if it were additional money in the Series A financing, the future financing. In the post-money safe, which is what they have on their website now, the safe itself becomes more dilutive to the founders. It's essentially treated as if it were in existence prior to the investment in the Series A, and therefore that money is treated as if it converted into stock in advance, and therefore the price per share is driven downward by the conversion of the safes itself, which is just more dilutive. Nothing wrong with that. But if you issue a lot of money in safes and you use post-money safes, it can actually be very dilutive to the founders. And so before you print something off a website, anything off a website and use it, you need to talk to qualified counsel or to have some experience in dealing with that. Not to mention there are securities laws issues with issuing securities as well, which you shouldn't really ever be issuing a security without talking to someone that can help you make sure you're checking the boxes there. So that's what safes are. They're a great tool, but they're not, despite Y Combinator's best efforts, they're not really something that is as simple as everyone hopefully intended. It does require some conversation and some thought.